Like, I think people believe like being able to flex on someone else is going to make them happier, but it's very fleeting. Like, I've done it. I know people have done it. I know people, multimillionaires, have done it, and they said, hey, like, that was cool for the month or 2 months where I can say, hey, like, I got this and you don't. But over the long run, a lot of people don't have any money to show for it. So, at the end of the day, you want to make sure that you're, especially when you're making good money like you guys are now, you want to make sure that 10 years down the road, you're still good.
Welcome to this episode of the Business of Athletes podcast, where we cover the business of athletes from all angles. And on this episode, we have the pleasure of interviewing Marc Russell from The Better Wallet. Marc, welcome.
What's good, brother? How you feeling?
I'm good, man. It's good to be back connected with you. You know what I'm saying?
Sir.
This is our second time hopping on an interview, doing this, man. And so I really just want to use this first period of our interview for you to tell a little bit about yourself, your background, and then we're gonna get into it.
Yeah, man. So I come from very humble beginnings. Came up through the foster care system. The day I was born, I was put into foster care. Both my mom and my dad were victims of drug abuse in Philly, and as I mentioned, put right into foster care. So 13 years of my life, man, I was bouncing back and forth from foster home to foster home within Pennsylvania, and eventually I was adopted at 13. So luckily I was adopted into a family that really prioritized education, and though I did play sports and I did okay in them, they always said, hey, like, I want you to make sure you get your education first and foremost, and if you just so happen to do well in sports as well, then so be it. So prioritized education, did well in high school, and then ended up going off to Penn State for schooling. But in terms of my professional background, so after I put myself through school for 4 years, I ended up, going and becoming a financial advisor and then a stockbroker. Well, stockbroker, then financial advisor, and worked my way up through the corporate America world, which no one in my family has ever done. So you kind of couple that with everything I learned from my time as being a stockbroker and financial advisor, and me paying off $80,000 of debt, managing my own money. Well, I should mention screwing up my money first, and then learning how to manage my money, and then everything I learned from just being a financial advisor, I created the Better Wallet platform, which is how you and I connected.
Man, so the Better Wallet, we're gonna talk about that, and I just want to kind of give a little segue because I know some people might be, wondering, well, Marc is not, a former professional athlete. How does this relate? Well, on previous episodes, with me and my former teammate Braden, we talked about the fundamentals of personal finance and of investing. And so I took Marc's course, The Better Wallet, and it really felt to me like a playbook, right? So let's talk about The Better Wallet. Let's talk about your course, man. So you built it, and what's been the most important thing to you about building the Better Wallet? Like what's that experience been like, and what things have you taken away from it?
Well, like the whole premise behind why I wanted to create it was I realized that when we are put into a position where we're making money, let it be a little bit or a lot of it, we don't know what to do with it. A lot of us, we didn't grow up learning how to budget or buy ETFs or mutual funds, what have you. So I wanted to create a course that helps people streamline their money and then invest more of it. And then also, how can we make sure it's protected from a tax standpoint? Because you can make a lot of money, but if you're not protecting it from Uncle Sam legally, then likely you're going to lose a good bit of it, right? So how do we go about avoiding that? So the day that I quit my corporate job around this time last year, I started working on the course. And I put my heart and soul into it. Just make sure that if you go through the program, it's literally, as you mentioned, a complete playbook on what you need to do in order to get your finances together so you can invest for you and for your family. So the biggest takeaway for the course, man, is there's a lot of things that you can do in order to improve your finances. But I want it to be a blueprint that takes out all the BS. There's a lot of BS out there on the internet about what you should do, what you shouldn't do. And I just took what I know my people need, in addition to what I've learned as a financial advisor and stockbroker, and gave you everything you needed to know in that course without all the fluff. And it's in addition to all the coaching that I provide. And as you know, my students have full access to me, so it allows me to help craft their portfolio as well, which has been maybe the most rewarding.
What's in dealing with your students, right? What is the most important fundamental aspect of personal finance, right? Like what would you say, like I know every situation is different, right? But what would you say this is the theme that I've seen the most when dealing with my students? Like this is the most important fundamental to have in your toolkit. This is the most important thing to have as a foundational base of your personal finance.
Yeah, I think it's just that. It's making sure that you have a strong financial foundation before you start to build a house on it, right? So, like, what happens if you build a mansion? Like, we'll use Tyler Perry's house, right? So, Tyler Perry has this mansion in Atlanta. If his mansion was built on unstable ground, what's going to happen? It's probably going to crumble to the ground eventually, right? And that's what I see all too often is people try to out-earn bad spending habits. They try to out-earn the fact that they don't have a financial foundation. And then what happens, what we start off with, where people end up going broke. And it's a lot of times it's not their own fault. It's because they weren't taught what they needed to do in order to have that solid foundation. So in terms of like what's most important, it's making sure that you're playing offense, right? You're making that money, but you're also playing defense. And I think that's also very, really important because we all know that you can't win a championship without a great defense. So you go, you learn how to budget, you make sure you know where your money's going. And, you know, I'm not one to say, hey, you can't buy this, you can't buy that. But I want you to make sure you have a plan for your money so you know where it's going, so it's working for you. So if you say, hey, like my goal is to, so you have a little one, you know, I want to make sure my little one goes off to school, they don't have to worry about paying a single dime, right? So that money that you're making, a portion of it should be going to a 529 account or a custodial Roth IRA or whatever it might be, in order to make sure that they are taken care of into the future. But I think a lot of times people, you know, they make the money, they spend it on things that they really don't need, and then 10 years down the road when they want to hit a certain goal, let it be buy a boat or buy a car or buy a house, they're trying to essentially make more money in order to reach that goal when they could have planned for that in the past and invest for it in order for them to, you know, really make that goal easier to achieve.
I heard a couple things in there: playing defense, and then managing the spending habit. So what does playing defense look like right now?
Two different ways, man. Like, so the first one is budgeting, and I think, you know, budgeting tends to have like a negative connotation because like the way that we were raised, budget means that like you're restricted, you know, you can't, right? Mm-hmm. What budgeting, the way I want people to really think about what budgeting really means is budgeting is just having a spending plan so you know where the money's going. Every big corporation out there, they have a spending plan, they know where the money's going. They might call it a budget, they might not, but if you go to a major CEO and say, hey, like, you know, go to, I don't know, like Mark Zuckerberg, where's your money going? He could probably tell you where the dollars are going. That's essentially what I want people to do. You know, he's not restricted in what he's able to pay for certain things, but he knows that he has certain dollars allocated based off his specific goals. That's basically what a budget should be. And if it's not that, then you're essentially doing it wrong. So budgeting is number one. And then as it relates to defense, also just making sure that you're not falling victim to lifestyle inflation, which for young, successful athletes, you're somewhat, you work to get to the point where you're making a good amount of money because of the skills that you have. And that can be a gift and a curse. It's a gift because, you know, you can give that money to your family. They will have when they, you know, for the most part of their life, they probably didn't have. But the curse is the fact that you have all this money and it's easy to mismanage it. Very easy, especially after taxes, right? So don't fall victim to lifestyle creep. So you're making all this money. Figure out like what makes you happy. Figure out like, okay, like what makes me happy is that like I have that new car, I have that new home. But if jewelry and all this other stuff doesn't make you, you know, remotely more happy, then you shouldn't go and pay for it just because you saw someone else have it, right? So I think that's one of my biggest learning lessons in life because I fell victim to that as well, albeit it wasn't, you know, millions of dollars, but it was, you know, when I made my first six figures, I said, well, my friends have this new car, my friends have jewelry, my friends have these new shoes, so I should go and get them too. But what I realized was I was buying these things to make these other people happy, but I didn't really care for that, right? I don't really care too much for cars. Like some people are car people. I happen to not really be a car person. So you go and you think about what makes you happy and try not to fall victim to lifestyle creep. It's easier said than done, but just really think through what you want your life to be in 10 years. And if the things that you're buying on a day-to-day basis isn't going to help you get closer to that goal, then you should probably retract back what that is and reallocate those funds to what's going to make you happier in the long term.
Man, I think you mentioned two things right there, man. Lifestyle creep is crazy because you see it a lot in a locker room because one, there's so many different tiers of guys in the NFL locker room. I don't know how it is really in MLB or NBA locker rooms, right? But there's so many different tiers of guys. You got your undrafted free agents that are, pretty much week to week, year to year trying to make a team, right? And trying to, get their salaries. And then you have your guys on multiple year deals, and you got your mid-career guys, 4 to 5 year guys, probably got a good chunk of money, but nothing that's going to retire them for their life, right? And then you see it, and even myself, even I have to fight against it, right? I see the guy driving the Range or, the Rolls, you know what I'm saying? And it's nice. It looks real good, man. It's like, I could do that, but it would really hurt. You know what I'm saying? But it would really hurt in the grand scheme of things. And if you're not looking at the opportunity cost, keeping up with the Joneses can really burn you. It can really burn you.
I think J. Cole put it perfectly. He was saying, love yours. Like someone's always going to have a fancier car, a better looking girl. He rephrased it differently, but a better looking girl, right? A bigger home. Everyone, like anywhere you go, like you can make millions of dollars and Drake is going to have something better than you probably. And Drake's probably looking at Jay-Z and saying, wow, Jay-Z's probably looking at Bezos, right? So like, there's always someone doing more than you, but again, it comes down to like what makes you happier. Like the richest people, in my opinion, the wealthiest people are the ones that say, hey, like I can afford that. Like you any day can go out and buy a Porsche if you really wanted to. But you say, hey, like, here's the things that make me truly happy. I want to make sure my wife is good. I want to make sure, whatever, happens with football, I want to make sure that afterwards I'm straight. I want to make sure my kid's good. I want to make sure there's a roof over top of my head, my family straight. Like all those things are from what we've like talked about. Those things are like really, really important. Right. And, the same way with me, like outside of so I have a 2011 Kia Sportage, right? I could easily afford a more expensive car if I really wanted to. Parked right beside my car is a Bentley. The Bentley is probably worth, I don't even know, like what are Bentleys?
I haven't even looked those up.
This thing, it's sharp, man. I can't even lie. It is sharp. But if you were, I know the guy who actually owns a Bentley. If you were to compare his life compared to mine in terms of happiness, I could tell you that I'm way happier than him. He's stressed out. He's working hard in order to pay for these payments, but he could have just not did that. Like, I'm not saying you have to go back and get a Kia Sportage or 2011 Kia Sportage, but like maybe if you bought something that actually made you happier, maybe it might have been like a Cadillac Escalade, which doesn't cost as much as a Bentley. Would you be happier? So that's really what it comes down to, man. Like I think people believe like being able to flex on someone else is going to make them happier, but it's very fleeting. Like I've done it. I know people have done it. I know people, multimillionaires have done it. And they said, hey, like that was cool for the month or 2 months where I can say, hey, like I got this and you don't. But over the long run, a lot of people don't have any money to show for it. So, at the end of the day, you want to make sure that especially when you're making good money like you guys are now, you want to make sure that 10 years down the road, you're still good. Because unfortunately, unfortunately, life is long. Life is really long, especially after sports. And if you're done playing at 40, you still have a long time to have to live off that money.
And if you're talking about the NFL, it's really like 30 or 20, 29, maybe even younger for most guys. Yeah, you'll be generous with 40. Yeah. that's a MLB great legend
Yeah.
career. You know what I'm saying?
Even Tom Brady, man, like Tom Brady still has a long life after he's done, and he's one of the oldest in the league and still doing well as of yesterday.
Yeah.
So like, so you really want to prepare for that life after sports, but then like don't get me wrong, have your fun, but make sure that your fun isn't burning your pockets, like
Right.
burning holes in your pockets.
Right. And then the second thing you mentioned, I want to go back to that. You mentioned about like a lot of guys, it's the first time that them and the people in their family have had access to that much wealth. And so obviously you want to make everybody happy, right? You want to get mom the house, the car, you know what I'm saying? But if you really look at like a rookie contract, you really can't do it. You really can't do it yet.
Yeah.
You really should wait. And I know I just know it's hard to have that difficult conversation to say, especially to somebody like your mom or a sister or anybody in your family that's cared for you to say, hey, you know what, look, I know you've read this and it looks like I'm making 1.3 over 3 or 1.8 over 3, whatever that number is for a rookie now, right? But it's you got to have that difficult conversation. That's why a lot of times I like to think about money and wealth. It's a lot about the internal game. Like you gotta do a lot of self work and a lot of like internal processing to know like, okay, I can handle this level of conversation of wealth, of getting into these different things. Because if you don't know, then you start overextending yourself, and now like you can't have those difficult conversations with mom or auntie or uncle. You know what I'm saying? And so you got to know how to manage your own emotions first before you can manage your money, because then you start looking at things like investments, right?
Right.
And that's the next thing I want to get to. But like you start looking at investments, right? And everybody thinks once they start investing, it's just going to be up, 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 up from there. You're just going to, but the investment game, like you got to know how you're going to react when you see
Right.
a loss of 10, 12, 15, 20%. Like look at this year. It's been crazy.
Yeah.
Right. And if you started investing at the top of the 2020, like, okay, we good. Everything's going well. People have made 40, 50% on their money. And now it's when, it's looking bad. So
Right.
you got to really know how you're going to react, and you got to really be locked in, because that whole family situation, like you really got to be ready to tell people no.
Yeah.
And you really
No,
got to understand why and say, you know what, I'm okay with telling people no, and I'm okay with what happens after that. You know what I mean?
Right, right. And it really comes down to, because, I experienced that, I'm the first one from my family to work in corporate America, where, money is fine. You make a good chunk of change, but the money that I was making coming out of school was the same amount that my parents made collectively at the height of their career. $60,000 was like the most that they ever made collectively, married, filing jointly. So it was a normal conversation for someone to come to me and say, hey, like I need, and it was not that much, but like I need 20, I need 50, I need 100, I need, so-and-so's birthday is happening. Where I'm from, it was normal for someone to go to jail for some reason, right? Like, so-and-so needs bail money, whatever. Like that, I mean, it's real stuff that we have to deal with, because we're maybe one of the first people to actually like make it out. So, but the conversation is, not only, as you mentioned, hey, like, no, but also help them prioritize it in their head. Hey, like, I'm going to be making, let's say you're making $1 million after taxes and all that stuff. I'm making $1 million as that, like with that money, what I'm going to do is I'm going to, maybe you want to go and buy your mom a car, or you want to go and send someone off to school, or you want to buy, your nephew some new shoes for school, whatever it might be. But allow them to understand like what that prioritization is, so then they understand it. So it's not just a no because, Mark's being cheap. It's a no because he's prioritizing these other things, and he's going to look out for me hopefully later when, you get that next contract or whatever it might be, or you get that new endorsement, whatever. But yeah, you want to make sure you're helping to like prioritize the stuff in their head. Because I had the same thing even afterwards when I was paying off my debt, where people are asking me for money, family, whatever, and it shifted from a no to, hey, like I plan on being debt free by the time I'm 30 in 2020, January, or what was it, July 2020. And once I gave that conversation to them or had that conversation with them, then they understood the path that I was going in, and me giving them a large chunk of change for whatever reason was going to shift me completely off course, or it might not. I won't be able to make as big of a debt payment that month or whatever it might be. So, having those conversations and giving that perspective is really key. In terms of investing, man, you're totally right. I mean, investing is a journey, and I think when people got into the market in 2020, I think and I know that money was cheap. The Fed significantly decreased interest rates. That means that stocks tend to do really well, and because stocks tend to do really well, everyone believes that they're winning, and it couldn't have been further from the truth, because sure, you're winning in the short term, but we're all long-term investors. As you know through the course, long-term investing is the way you go. And I learned that because I grew up at Vanguard, which is all about long-term investing and being there for the client and making sure you're investing the right way and controlling what you can control. So when people are they're jumping into, I don't know, I'm trying to think of the stocks that are popular then, like Peloton and, even some of the
AMC.
crypto. Yeah, all that stuff, like, sure, like jump in, but it's nothing more. It's probably worse than gambling, in my opinion, because you're going and you're putting money into stocks that haven't proven anything over the long term. And when I say over the long term, over the last 10 years, and you're putting your money in with the hope that you're going to make it out with a lot of money. And unfortunately, a lot of people were burnt because of that. But when it comes to investing, it comes down to long-term investing. Make sure you're investing based off of the next 10, 20, 30 years, not just the next month or next day or the next hour. That's why day trading doesn't work. And then also is risk mitigation, right? So if you are new to investing and you have no experience, like that's like saying, hey, like I'm going to get off the couch and I haven't like ran ever in my life, but I'm going to go and do a marathon, right? Like you likely won't finish the marathon. If you do, you're not going to, you're going to be really, really tired. So what I would compare it to is like you want to kind of progress up. Because a lot of people in 2020, they progress straight to the riskiest thing that you could ever possibly do, and that's buying individual stocks. The jogging or the walking of the investing world is going and trying out like different ETFs and mutual funds, which are what they call index funds, which in layman's terms is you're tracking the largest market or the largest companies in the market, and as they do well, you do well. And buying an index fund does nothing but track those specific companies. And given how the companies have been doing over the long run in America, likely you're going to see a good amount of appreciation. So that's the way that normally I go about coaching and teaching my students on how to go about investing. And then, later down the road, if you say, hey, like I got this ETF and mutual fund thing, I want to add in some individual stocks, you could do that as well, but make sure it's a smaller part of your portfolio.
Man, so let's dive into that. And I know you cover this a lot in your course, but I'm gonna ask you to give out a little bit of it for free, so don't be too mad at me. So
let's do it.
I've had some questions from friends, right? And how do you buy an index? How do you buy the S&P? How do you buy the Dow? Like just really briefly, like how would you do that? What's the best way to get started? Like you said, that's the walking phase. What's the best way to do that in your opinion?
Right. So let's kind of just start with a couple concepts. So we talked about risk management. Just make sure your risk is not as high as it could be, right? So making sure that you're walking before you're running. And then the other concept is the concept of like diversification, which is the most important term in all of finance. Make sure that you're diversified across the board. That way, if one stock does horrible, then you're not losing all your majority of your portfolio, right? So the cool thing about ETFs and mutual funds is that they are naturally diversified. So you're buying 500 plus different stocks all at the same time with a few clicks of a button, and you're able to do that for less than $100, right? So that's the concept that I want you guys to understand. The second part of it is if you're looking to buy into those, I think a lot of times people think it's really complicated, and back in the day it was really expensive in order to get into mutual funds, but ETFs have made it really, really easy for you to go and you could buy them. The amount of time that it takes you to open up an Instagram account, you could probably open up an account at Fidelity and invest into a index fund. It's really simple. So you go, there's a whole list of index funds that track the S&P 500, which it's the Standard & Poor 500 is like the 500 tend to be the largest stocks in the country. Again, diversified, and you can go into VU, which is the Vanguard S&P 500 ETF. There's a bunch of other ones. You go, you choose it, you put in how much money you want to put into the actual fund. You press buy, and then if you're buying, for example, right now it's 2:30 on what is the Tuesday, you would automatically own those stocks within that ETF. But you won't see the individual stocks. You won't see the Amazons, the Apples, and the Microsoft unless you look underneath the hood. You would just own VU, the Vanguard S&P 500 ETF. And then what happens is, as the market continues to do well, historically, you'll participate in the growth of that specific fund, right? So you're basically, the way I look at it is like you're basically investing into the capitalism of the United States, because the companies and the people who run those companies are paid more to increase the share price of the company or of the stock. And that's capitalism, like throughout it all. Like that is literally capitalism. They're getting paid in order to increase the share price. As the share prices increase across the board, across all these 507 different stocks, you are participating in that continuing growth. So over the long run, you should expect to see 10% on average per year. Now, as you mentioned before, there's ebbs and flows of that. So one year it might not be. So what I want people to understand is that it's not 10. Like next year it won't be 10. The following year it won't be 10. The next year after that it won't be 10. It will be negative 10 maybe this year, maybe positive 20 next year, negative 5, then positive 27, right? So on average over 10 years, that's what it looks like. And if you look at the previous years, that's pretty much what the flow looked like. And on average, the historical market, it has been 10% per year historically.
Right, man. So you covering a lot of things that I want to get to it, but I'm gonna get to it by asking you questions. So right, mm-hmm. so you talked about long term investing. You talked about the ability to not be to not want to day trade, right? To not just do the single stocks. So dollar cost averaging, right? You talked about it could be down -10 today, up plus 27 next year, right? How do you use dollar cost averaging, and do you recommend it for the average everyday investor?
Yeah, I think the cool thing with dollar cost averaging, which basically means if you have $12,000, instead of just putting the money in, all 12,000 as a lump sum, you say, okay, every month I'm going to put in 1,000 for an entire year. So the benefit of that is that it takes out the emotional aspect of investing, where you will say, like, for example, if today was the day that you were going to put in $1,000 for this month, you would say, oh, well, the market's down, what was it? I think it's down 400 today. It was down 500 yesterday, right?
Yeah, it's down 1 point. The S&P is down almost 2%.
Right. So anyone who is human would look at it and say, oh, like, I don't know if today is the best day. The emotional aspect, we're not talking about like what actually makes sense, right?
And it's funny because that's so counterintuitive to what you should do.
Right, exactly. So it's that, or it could be the opposite. Oh man, the market's doing really, really well today. It's going to be pretty expensive. Maybe I'll just wait for the next dip, right? So dollar cost averaging can kind of take out that emotional aspect of it, or it could help you depending on if it's an automatic contribution. Now, if what makes it hard is if you're doing a lump sum and you say, okay, well, I want to put in 12,000, but again, if the market's going down, you could say, well, I don't know, like if I put in 12,000, if it drops down to 11,000, like how am I going to react? Am I going to want to take the money out? So it's like this cat and mouse game of like an emotional game that you're just trying to figure out what you should be doing. But in terms of what I think the average person should take a look at, I would say try. I think it's easier to take the emotional part out of it if it's a smaller sum of money. So if it's $1,000 versus like 12,000. So, and the other cool thing about it is like if you dollar cost average, it has been proven to lower what they call the cost basis. So how much money you're paying in order to own those specific shares or those specific stocks.
Right.
So the goal is to have a really, really, really low cost basis and a lot of money that has been generated from that cost basis. Like that's literally what you're trying to buy things on sale, right? And the challenge with investing is that it's counterintuitive to like everything else, right? So if we want to go out and buy a new pair of Jordans and the Jordans cost $300 and then the next day the Jordans are $200, what are we going to do? We're going to buy them at $200, right? It could drop back down. It could drop down to $150, but we're going to be like, yo, we're good at like $200 because it used to be $300.
Right.
With the market, people don't think the same way, which, I did the same thing when I was a new investor, but learning from it, I've realized that you want to buy when the prices are down. And with dollar cost averaging, you're able to do that because you're going to take advantage of the down days, the up days. And if you're investing like during a recession, you're taking advantage of these really, really low prices. And then 10 years down the road, you're going to look back to me and Kari and be like, I'm really happy I listened to you guys because I bought during those down days.
Yeah.
And now I see more of that appreciation versus what happened in 2020 when people were buying at the top of the market. And now they're looking back and saying, wow, like I quote unquote lost some money, but it's because of when they bought in. But
Right.
if they look 10 years from now, they're going to say, wow, I'm really happy I bought in 2020. But the goal is to not sell out unless you really, really, really need to.
Yeah. And so, you always want to look to the right. So like you can look at past performance of, a stock, but the S&P, I mean, it's like 50 years of data. Like you mentioned, 10% on average, you're going to do 10%. I'd love to put my money in a place where I know in the next 10 years, I'm probably going to have made 10%. Now with single stocks, you mentioned single stocks and crypto, that's a little bit riskier because you're not as diversified. What's your philosophy and your fundamentals on stock picking? Because a lot of people have a lot of different mentalities about stock picking. Some say they just never touch it because in the long run it doesn't work. How do you add that to your game plan?
Yeah, definitely. So you're totally right. It doesn't work over the long run. And it's not just me saying that because I, maybe was burnt one day or whatever. This is historical knowledge, like data from some of the top investors out there. Even Warren Buffett says that individual stock picking does not work on average compared to index funds. In fact, back in 2000, I want to say it was 2005, he bet like his shareholders that hedge funds who have all the money in the world cannot outperform a index fund. I think it was a Vanguard index fund over the next 10 years. And he bet them and everyone was like, oh, like the hedge funds will obviously outperform the index funds. And I forget the actual number, but I want to say it was close to like 300% at the end of the 10 years. The index fund was 300% more than the individual stock pickers and what they were able to accumulate in value. Meaning that the people that have all the resources, all the money, all the knowledge, they were not able to beat the index over those 10 years. And this is coming from Warren Buffett, right? So like he knows a couple things, right?
Yeah, right.
So that's just something you want to keep in mind that's really, really hard to do. Now, if you really want to get into stocks and you want to do stock picking, go for it. But don't make that the majority of your portfolio, right? So one thing I tell my students all the time is that it's kind of like Thanksgiving dinner. So if you go to mama's house, so I went down to my mama's house. She's in Mobile, Alabama. So I went down that way. And if I pulled up and said, Mama, I just want the sweet potato pie. I just want the biscuits. I just want, the sweet tea. what's she gonna look? She's gonna be like, what? You're not gonna eat any greens. You're not gonna have any turkey. You're not gonna have, any of these nutrients, right? But instead, you're gonna eat all these like carbs and things that are unhealthy for you, right? That's the way I look at ETFs, mutual funds, and then stocks, right? Like, cool, you can go and satisfy your sweet tooth, but if you continue to eat that way, especially if you're an athlete, right? Like, we can kind of relate that part into it. If you're an athlete, what's going to happen? You're not going to perform well. Like, you're not going to perform well in the field if you're just eating biscuits every single day, right? It tastes good when it's going down, but like otherwise, like it's not going to help you perform. Now, you can go and have that good meal, and then also have the biscuits and the pie and all that stuff, but the biscuits and the pie, that should be like a smaller percentage of your overall portfolio. The same way as an athlete, you can eat really healthy, and 10% of the time, if you go out and you have, I don't know, what's your favorite like takeout food?
Shoot, man, give me a cheesecake from Cheesecake Factory, man. That's
Right.
that's what I get right now. That's
Right. You get yourself a cheesecake, go for it, right? So buy buy crypto, whatever you like, that one stock down the street that you think is going to, blow up, go for it. But make that a smaller portion of your portfolio. But if you just ate cheesecake all the time, you're going to walk onto the field and coach is going to be like, "Yo, what's good with you? Like, what's going on? Like, what's up with your body of work?" And that's the way I look at, like, when it comes to investing, right? You can have that sweet tooth, but you want to make sure that you're taking care of the body of your portfolio first.
right, man. It's really, like you said, it's all about numbers. Like, what has worked in the past historically? Index funds. And if you're not somebody like Warren Buffett, like, correct me if I'm wrong, but his Berkshire Hathaway portfolio, he's beat the market. But that's because, he's getting billions of dollars in dividends from Coca-Cola. And
he has a lot of institutional money as well. So that means that, you have the individual retail buyers, but then you have the institutional pricing that you get if you have a large chunk of change, and they tend to outperform the retail investors as well. So, like,
all right, break that down before you move on. Institutional versus retail, what does that mean?
So a retail investor is like someone like you and I, where we can go and buy individual shares, and there's different share classes for that. But if you're an institutional buyer, if you're a company or someone like Warren Buffett, who is worth billions, they get a certain share class versus someone else. So they can buy in, and this is the reason why they're able to do that, is because instead of us giving them, 5,000, 10,000, 20,000, they're giving 5 million, 10 million, 20 million, sometimes billions of dollars in investing into these companies. And the companies say, well, if you scratch our back, we're going to scratch yours. So we're going to offer you lower pricing, which tends to, obviously lower the fee, and then that could lead to higher performance. So times that by 50, that's what Warren Buffett is able to do versus a retail investor, is to get into those, certain investments that tend to do better than the retail investors. But it's really, really hard to achieve. Like, there's some companies that can't even buy into those share classes because they don't have enough. So that's another part of the game that I'm happy to dive deeper into one day.
Yeah.
But
and I'm glad you called it a game, because that's how I
really
see
is.
it, man. Like, there's a lot of people, like you said, who jump right into the stock picking, and they think they can play the game at the same level as investment banks and Berkshire Hathaway and hedge funds. It's like, you just can't play at that level. That's like taking a D3 junior or a junior college and trying to send them up to play versus, the NFC All Pro, you know what I'm saying? The NFC Pro Bowl team. You know what I mean? Like, it's it's not going to work. And if you think, like, it's really, the market, as I see it, is like just a big competition, right? You're competing against, everybody else in the world who's buying and selling stocks. And if you don't have an edge, you're going to get crushed every time.
Exactly.
And for retail investors, I think the edge is having a super long time horizon. That's how I see it. And if you want to go make money somewhere else, like, go get cash flow somewhere else, like real estate, or just from your own skill set. You know what I
Right.
mean?
Yeah.
That's kind of how I see it.
Yeah, because the game in investing is how can you receive steady growth on your portfolio, right? Like Warren Buffett, again, another one's, he said like rule number one, don't lose money. Like rule number two, don't forget about rule number one. Like risk mitigation and just risk management is so important in investing. And unfortunately, when a lot of people got into the market in 2019, 2020, 21, they followed people online. I'm just telling you what it is, like because I saw it and I witnessed it. They followed people online. They said, "Hey, like buy this hot new stock, buy this crypto, blah blah blah." They didn't have the background. They probably were new investors themselves, and unfortunately, people listened to them, jumped in. They didn't talk about risk management or ETFs or mutual funds or anything of that nature. Got burnt, and now they believe that investing is too risky, which investing the wrong way is definitely too risky. Then those people, the funny thing is, those people who used to talk about crypto, individual stocks, and all that stuff, guess what they're talking about now? ETFs and mutual funds. Because they know that it works.
Man, it's crazy. It's a whole game, and when you really look at it that way, a lot of that stuff that you see on Instagram, you got all of these people selling courses as far as options and things like that. Now, I'm not talking about actual fundamental courses like yours. I'm talking about options courses and futures trading. Like you really, again, you have to go look at the numbers. What percent of people win those games?
Right.
That play those games.
And those people selling those courses, I promise you, if you ask them how much have they lost over the course of the last year to the last 10 years, I promise you they will likely be at a negative because for every gain that they're telling you about, oh, I made 15,000, made 20,000, there's another loss that's probably worse than that. And I know it because I've talked to those people before and said, hey, like, make sure you're telling the complete story. And like a lot of times they'll come back and say, well, yeah, like, and the reason why they tend to be selling those courses is because they're not making as much money as they're saying that they're making. Like, tell me one time that I told any of my students, hey, like, I made X amount of dollars on my ETFs and mutual funds. Like, I know that it's a long game. I know what works. I know I talked to millionaires that have done it and they followed the playbook and they were able to make, their first million or 5 million or whatever, become billionaires through index investing. But not once would I come out to you and say, hey, like, I made this, I made 30%, I made 40%. Like, no, that's not the game. But I the way that I brag, Jay-Z said, I brag different, right? The way I brag is like, I'm saying, hey, I'm diversified. I have money offshore. Don't put your money offshore. I have money internationally. I have money in emerging markets. I have money, some money is, somewhat in bonds. And then, I dabble in crypto and individual stocks as well. Like I'm not, I have a sweet tooth as well. That's how I brag, but you don't brag in in investing. The weird thing about it is like, you're not bragging as it relates to returns. Like you're bragging as like you should be bragging on, hey, like I met my financial goal, or I was able to send my kid off to school and pay for their schooling tax free. Like the rich people, they truly brag in how much money in taxes they can avoid legally, and then they brag in terms of like diversification, like where they have their money at. But you won't see them bragging about, oh, like I got X return, because they know that if they did get that 50% return on that one investment, that can easily turn the other way around. It could be negative 50, like we saw with, again, Peloton, and there's a bunch of other examples of companies just like that.
What was it, Zoom or something like that?
Zoom. Literally take all the hot stocks from 2020, and every last one of them, I want to say like 95% of them are doing way worse. I was looking at one. Which one was it? That is 90% down. It might have been Peloton. I have to look back at it, but tell someone in 2020 that Peloton just 2 years later wasn't going to be doing as well as it was doing back then. They'll look at you in your face and be like, "There's no way." Everyone has a Peloton. People are buying them left and right. There's commercials and all that stuff, right? That's what they said back in 2020. But now Peloton is struggling, as they were struggling before, but no one like wanted to like talk about it.
Yeah.
Like they always had like issues, just supplier issues. If you talk to anyone who got Peloton, likely they got the Peloton late. It wasn't right on time, right? Like they had pricing issues. There's a lot of issues with the company of Peloton that if you did some simple analysis, you would have seen that. But everyone on the internet, what they talk about, hey, like you need to buy Peloton stock. This is taking off. Zoom's a new way of like, people talking online. And then what happens? Competition pops in. Competition is the biggest equalizer out there.
And then forces change too.
Right. So
Like we're no longer in the house. People are going
right.
back to work.
Right.
Nobody needs, not saying nobody, but people don't need Zoom that much. That
It's
Peloton,
right?
Right.
And then there's competitors that come around. Like I used Zoom for maybe a good couple months before I started using Webinar Jam because I thought Webinar Jam was better for what I offered for my students. So all that stuff, man, is like really really important. But you want to think about like the long term time horizon or like the long term potential performance of a specific fund or a stock before jumping into it, because I think a lot of times people say, "Oh well, I think I can time it out. I know when it's gonna drop, and I'm gonna get out at the right time." Impossible. Like there's two different, like, this is my motto. There's two investors out there, types of investors. You have one who believes that they could beat the market. And then the second one is someone who used to be number one that now invests in index funds. That's the way I look at it. Because I used to be that person. I was like, even working at the largest mutual fund company in the world, I was like, you know what? I can time this out because I'm smarter than every other investor out there, even the hedge funds. And I thought that for a good year and a half, 2 years. And I got burnt the hell and back. Buying random, wanting to buy like weed stocks, like weed. All my homies are locked up because of like weed charges. Now it's gonna be legal in the United States, so now I'm gonna go and make sure I invest into it, and I'm gonna make off like a fat rat. What happens? You get burnt because you don't know when to sell out. People hype it up, and it falls, and then maybe it might bounce back up, and then you say, "Oh my God, like maybe I should stay in, maybe I shouldn't." Then you end up selling out when it's at the bottom. Then what do? You lose the money, and then what do? You want to try to recoup the losses by taking on another, going and buying like an individual stock that you think is going to do well. What happens? Maybe you might make 10%, but you're not making the full amount. And then you say, okay, well, here's this other opportunity, Zoom. I'm going to put my money in that, and I'm going to recoup all my losses from before, and then
start chasing returns.
Right. So it's like you can play that cat and mouse game. You can have like all these like computers up with like these spreadsheets and charts and like just making sure that you could do all that stuff. I've done it, and you could do that, or you can do what we do. We press a couple buttons, we buy into index funds, and we sit back and chill. Right. What I call index and chill. So you just index, you chill, and when people are talking about their returns or whatever, and like how much money they might have made or how much money they've lost, you're like, hey, I haven't looked at my portfolio. I just know over the next 10 years, I'm going to probably get 10% annually, and I'm chilling on that, right? So again, kind of going back to how we started with, don't compare yourself to someone else. Don't compare your investments to someone else. Make sure your investments work for you and for your specific goals, and don't try to, chase after what other people are doing.
Yeah. Nah, man, because I watch it a lot, and I'm not going to call any names, but I do take in a lot of like the media that's on, YouTube, a lot of the, interviews and stuff. And there are a lot of people claiming that they know that they have this system that says, hey, look, I know the best entries and exits, and it's really good marketing. It's
really good marketing.
It's attractive. It really is. It's really good marketing. But the numbers, man, show you that it just doesn't work. Now,
right.
If you're talking about ETFs and stuff and you're looking at the S&P, what are we down? We're down about maybe 14% from the highs last year. If you say, okay, now's maybe a good time to buy those, maybe go a little bit heavier, that sounds a little bit right as far as, numbers go, and, just looking at the past, but still, making predictions about when the bottom is in and, what the recession is going to do and what the Fed is going to do. It just all seems really, really pointless.
Yeah, you kind of have to control what you can control, right?
Yeah.
So you can control how much money you put in based off of like how much money you're earning. You can control how often you put that money in, let it be, lump sum, or you could put in, once a month or once a week, whatever you want to do. And then you can control what they call your asset allocation, which is basically what you do in order to mitigate risk, where you say, okay, well, I want X percent in stocks, X percent in bonds, X percent in cash. And then, you can take a layer below that with the stocks and say, okay, well, I want some international, I want some domestic, I want some that's emerging markets, I want some that's invested into technology, whatever it might be. You can control all that stuff. You can't control the market. Like the way I look at it is like controlling the market is like trying to control like LA traffic or Tom Brady or Kanye. Like you can't control that. Like
Right.
it's really hard
Right.
to. Maybe some people can, but like it's really really hard to control that stuff. So what if you can just not try to control it and focus on what you can control? All that stuff is really really key. You mentioned how far index funds are down this year, which again we talked about the ebbs and flows and how that's normal. When it comes to index funds, yeah, like at the end of the year we might be down, let's say 15%. 15%, if you look at the historical market, that's pretty easy to recoup from. Like you can make that back pretty easily. Like in 2020, was it 2021? Yeah, last year the market was up around like 27%, right? So you can make that up. Now, the challenge with the individual stocks, because you might have some people on the line saying, okay, well, I hear everything you're saying, but I'm still going to do the opposite. Consider this. Let's say you buy 3 stocks, and those 3 stocks, they just don't do well with, because, they hype them up, you buy into them, and they don't do well. Let's say you lost 50% of that money. So 50%, let's say you, it went from 1,000 to 500. In order to recoup that loss, like a lot of times people say, okay, well, I need to make 50% in order to like recoup that. You need 150% in order to recoup it, right? So you need not only the money that you lost, but also the money on top of that in order to make up for that loss. So if you're doing the numbers right, you would say, okay, well, I'd much rather lose 15%, and then whatever that number is, let it be like 27 to 30% that you need to make up in order to recoup those losses. I'd much rather do that than have to go and potentially make up for the losses and have to yield 150%. And sure, like there might be that one stock might take off and might do really well, but my question back to them would be, like, if you believe that you can do that, what's stopping everyone else from doing the same thing? Like,
Right.
do you actually have information that no one else has? If you do, that's insider trading. You can go to jail for that, right? But likely you don't have any insider tip, especially if it's already on the internet or someone's talking about it in one way or fashion, or you're on some Discord channel. Like people already know about this stuff, and a lot of times it's already priced in. So don't think that you're getting ahead of the curve. But again, like a lot of times people, they hear what we're saying and they go and they say, oh, I'm going to do otherwise. And then, down the road, they come to you and say, hey, like I'm done playing that game. Like I want, another way I look at it is like, hey, like I want to get married to like something as long-term versus like the short-term BS that I'm doing. Right. So like, I'm done dating stocks and I want to have like a long-term relationship with like investing, right? Because being married, for example, has been proven to help with your longevity, your overall well-being, all that stuff. But sure, it's fun to go and date and go around and talk to different girls, whatever. But over the long term, that kind of burns you out, and you might end up losing more money than what you're actually gaining, kind of going through that route. So that's another analogy I would compare it to. But
Yeah,
it takes
man.
some guys a little bit of time to figure, guys and girls, that marriage or just having one person is the right way to go. But you have to let them experience life in order to figure that out for themselves.
Facts. Yeah, man, because like if you think about it, you look at the people who who sell these things and they say, oh, well, I made, this amount of return on Bitcoin, this amount of return on, I bought Apple in 2010 and I made this, or I did that and I did that. And nobody wants to just sit back and be like, yeah, I made 10% on my money over the course of 10 years. It's boring. Like it's
not sexy. It's boring.
It's not.
Yeah,
it's boring. And so like nobody wants that. Nobody wants to play those games. But like you said, man, and it sounds a lot like ball. And that's why I'm glad we could have this conversation, because that's a lot of coach speak right there. Is control what you can control, right? I hear coaches say that all the time. Control the controllables. Control what you can control. Focus on your job. Do your job. You know what I'm saying? Make the best decisions you can make, and then see how it plays out. Just play one snap at a time and control what you can control.
One snap at a time. That's the thing.
And when you talk about this investing game and the money game, it's a lot like ball. It's a lot like sports, man. Control what you can control, man. So that's what you're teaching people to do in your course, man. And so before we wrap, I know we're getting up on our hour right now. So tell people where they can find you, where they can find your course. And we definitely gonna have to do this again, man. And,
yeah, man. I'm always
in.
down. I appreciate you having me on. But yeah, guys, just in general, I'm in terms of who I am as a person, I'm probably the most down to earth person you could ever possibly meet. Like, I'm that dude that just happens to talk about finance, but like I'm just a chill dude that just wants to help people. Like, I get it from like my dad. My dad used to give back to everyone that he possibly would give a shirt always back to anyone who would need it in the middle of a rainstorm. And that's basically who I am. So, if and when you choose to follow me on Instagram at BetterWallet, BETTER, and Wallet, WALLET, just send me a DM. Be like, yo, I'm popping in. I was listening to BOA, and I just like what you had to say. Whatever, like, just pop in and say hi. Like, my whole thing, my family's from the South. I know Kari's from the South. When you go into someone's
Alabama
crib,
to be exact, you know what I'm saying?
Yeah. Yeah, if you pop into someone's crib, like, always say hi. If not, you're going to get cussed out, right? So, like, come through, send me a DM, and, if you need any help, I'm here for you. Like, let me help you out. You don't have to take the course if you're not ready for it. But I have a lot of free resources, a lot of free game that I put on my page, and the goal is to help people that did not learn how to manage their money growing up. I want to teach you guys how to manage your money so you can invest more for your family and for you, so you can put hammocks in your family tree.
Yes, sir. I appreciate you, man. Thank you for your time. Y'all tap in with Mark at the Better Wallet, and we'll see you next time. Peace.
Yes, sir. Thanks.